Rich from Chicago. Hi, Joe and Big Al. Love the show. Thanks, Rich. Have a question on spending my retirement funds. As long as I rebalance when needed, doesn't matter if I take from stocks or bonds. Or should I only sell what's high to keep my allocation where I want it? I've also read that you should only sell bonds and then rebalance when needed. Not sure what the best way is. Thanks, guys. Rich, that's one of the most intelligent questions I think we have ever received on Your Money, Your Wealth. Would you say so, Alan? It's one of them.
It's a good question because everyone is faced with this. And hardly anyone would even think about it.
Right. I mean, it's like, okay, well, here, I want to spend $30,000, a year from my portfolio. I'm going to put it in cash and then go from there,
Right.
So multiple ways to look at this, Rich. Really depends on, A, how much money that you have, where you're pulling the money from, and what other income sources that you have, and your tax bracket. So let's break this down because it's not as simple as do I buy, should I sell bonds? Should I sell stocks? Or a certain asset class is higher, so should I sell that one? A certain asset class is lower. So there's a lot of moving parts that are going on with this overall question. So I think which would make sense is that just to kind of give a high-level outlook of what you need to be thinking about as you start taking dollars from your portfolio.
Okay, good.
Okay? First things first is to see, all right, well, how much money does Rich have or how much money should Rich have? Okay? So that's kind of the first part of the equation. So if you're looking at retiring here soon, Rich, here's the math that you would want to look at is figure out, hey, what are you spending, right? What's your goal? How much money that you want to spend entirely, let's say, this year and then thereafter for life expectancy. So let's just assume it's $100,000 a year. All right, you with me so far?
Sure.
Second step is to figure out what other income sources are going to come to the household that is not part of your portfolio.
Okay.
So that could be real estate income, that could be Social Security income, that could be pension income, right? Or maybe part-time work income or whatever. Everything, but don't count dividends or interest or anything like that from the portfolio. Just look at what your fixed income sources are going to be. So let's say $50,000 or $100,000 is what he wants to spend. His pension, Social Security's $50,000, so that reaches his shortfall of $50,000. So the rule of thumb, Al, would be what?
Well, you take the $50,000 shortfall and you multiply it by 25 to give you an approximate amount that you need to have saved, which in that example would be $1,250,000.
Okay, so he needs about $1.2 million to create that income. So that's kind of his first step, right?
Yep.
So that's assuming, all right, that you're pulling 4% out of the portfolio, that the portfolio is growing 6%, the other 2% helps with inflation and taxes.
Sure.
The second step of all right, so that's kind of your first step. Do I have enough? Then the second step is really to take inventory to see where's your dollars at. Are they in a retirement account? Are they outside of a retirement account? Are they in a Roth account? Right? So just start taking inventory to say, well, what percentage do you have that $1 million to in each of these different accounts? Because let's say if he had a third in retirement accounts, Roth accounts, and non-retirement accounts, I mean, that would be ideal.
It would.
But the likelihood of that happening is probably low.
We don't see it very often.
Very, very, very seldom. I would say 90% is probably in a retirement account, 10% in Roth and other.
Right.
So you might want to start looking at diversifying your overall situation, getting a little bit more money into Roth, maybe looking at, all right, well, if I have a fixed income, what's my RMD is going to look like? How, so just kind of really getting the hands on tax. Because if you can save money in tax, that's going to have a direct correlation on your overall asset allocation, which I'm coming full circle to your point. Because if I have a lot more and if I can save more money in tax, then I can take less risk, right?
Sure.
So I will have more bonds, more cash, more fixed income type investments in the overall portfolio because I don't necessarily need to shoot for a higher rate of return.
So said another way, so if he needs $50,000 in your example, And if he's got more money in a Roth IRA or outside of a retirement account, it's more tax favored. And so to get that $50,000, there's going to be more tax efficient, and so you don't have to take as much risk in your portfolio to earn that same money.
Absolutely, right? Because the Roth money's all yours. A tax deferred, I mean, maybe only a third of that is, or 2/3 is yours.
Right.
Where a third might have to go to the IRS. So looking at the tax implications of everything is going to determine how you should be allocated, because how we believe is that you want to take the least amount of risk possible to accomplish the goal. So if I'm shooting for 6%, 5%, 4%, let's just take the least amount of risk to try to get that target rate of return. Then how you're going to be pulling your income is going to determine on your tax bracket, right, of where you're going to be pulling the funds from. So if I'm looking at, I need to pull $50,000 from the overall portfolio, well, I might want to only pull, let's say, $30,000 of the 50 from my tax deferred account. That might get me to the top of, let's say, the 12% tax bracket. The other dollars would want to come from the other two pools, right? So I can potentially pay zero tax on those dollars, remain in the 12% tax bracket, instead of paying 22% tax.
Right. So before you even get to selling stocks versus bonds, you're looking at which tax pool to pull money from. And the key there, as you said, Joe, is to manage your tax brackets to stay in as low a bracket as possible.
And then from there, as you're looking at the different pools, that's, of course, is when you want to start looking at, all right, well, which asset class is up? Which asset class is down? And then, yes, you would want to sell the asset class that is up to create that income. Some people will look at creating, taking dividends and putting it into cash and then spending that. You might want to put a year's worth of income just in cash and keep it easy. But yeah, I think you got the right point. But then trying to tax manage it, rebalancing it, and then keeping your tax pools in check, that's where it gets a lot more complicated.
Different tax pools, and so that determines what kind of investments go where. If you have money in a Roth IRA, well, that's tax-free. So you want your asset classes that have the highest expected rates of return. And those tend to be smaller companies, U.S. value companies, same internationally, maybe emerging market type stocks. Now, they're more volatile, yes, but over the long term, they tend to do a little bit better than the larger company stocks, which then, you would put those probably in your non-retirement account. Your safest assets, your fixed income, you might want to put in your IRA, because the fixed income produces ordinary income interest, which, by the way, that's what a retirement account does, and you don't want your highest growth in the retirement account because you just end up paying more taxes. So you got to think about that.
Or if you have like tax inefficient type investing, right? If you have a lot of turnover, let's say in a mutual fund, that's highly active, or maybe you're day trading or something like that and doing well, maybe you do that in your retirement account, just because those short-term profits, if you're successful, is taxed at ordinary income. You can defer that tax by just doing it in the retirement account versus outside.
Right, good point.
In REITs also is kind of a quasi-investment where sometimes you get highly appreciation in REITs, but it also kicks out really terrible tax income, so you might want to put that into maybe a Roth as well. So, different things that you want to look at, and as you boil this thing down, it can really make a huge difference.
Yeah, and so I guess the way that we kind of think about it is after you've got the right assets in the right type of tax pools, then you tend to look at everything as if it were a single account to try to determine, are we still in balance here? In other words, if I want to have 60% in stocks and 40% in bonds, the market's going to move. And at some points, you're going to have higher than 60% in stocks, some points maybe less. And so there's different schools of thought on how you take money out of the portfolio for income. My belief is to try to reduce trading costs is every time that you need to take money out, that you're going to have a rebalancing opportunity. So you take the money out of the account, or I should say the asset class that is higher than it should be. Let's say you want 10% in large company stocks and now it's 11% and you need some dollars. Well, it would be obvious to sell 1% of those large company stocks, and that's what you take your distribution, and then you basically rebalanced and created distributions at the same time. The problem with that in a bubble is if those assets are in your retirement account and you've got a lot of different assets outside of your retirement account and you're already in a high tax bracket, you may want to rethink that. So there's a whole bunch of things that you got to look at one time.
Right, and it's going to boil down to the planning that you look at up front. Is that okay? We're in now May. Can you believe it's May?
Yes.
Mid-May even.
Right. All right. So next month, we're halfway through the year.
Right.
So as you get closer to, let's say, maybe October, okay, you're going to have a little family summit like the Clopines do.
That's right.
Right?
We usually have ours in January.
Okay.
For kind of plan for the year.
Well, when you retire, you'll probably have it in October, just to plan for the following year, just a couple of months in advance.
Yeah. Well, we'll do it quarterly
Yes.
because I have more time.
Probably monthly.
Yeah, probably.
So here's what I would do is like, okay, well, now we're getting close. So I'm planning now for 2020, and I'm going to be like, all right, well, here's how much money that we need from the overall portfolio. We need $100,000, $50,000, $10,000, whatever that dollar figure is, right? And then I'm going to look at my tax situation and say, okay, well, this is where we were. This is where we fell last year. So let's just try to keep our taxes neutral, right? So then that's going to help you tell you what pools you want to draw from. Here's how much money that you want to draw from tax deferred versus your Roth versus other assets. Then you can build your allocation appropriately and say, I need enough fixed assets or safe assets in my Roth or in my non-retirement, in my retirement account. So if the market implodes, I still have that safety net to not blow myself up tax-wise. Because what Al and I have seen so many times is that when the market implodes and they don't have a tax strategy, then everything has got to come out from probably the wrong account. So now their accounts are down and they're pulling out more dollars and more shares, and it's getting killed in tax. So you're getting hit from both sides.
Right. So, something else I'll bring up, which is maybe a little unrelated, but kind of somewhat related, is when we talk about investing and having the right allocation, a lot of folks get confused about emergency cash fund. An emergency cash fund would be cash outside of your retirement account that is not part of your allocation. It's just completely separate.
It's outside of your retirement accounts strategy.
Correct. It's in just a normal bank account or savings account, and the purpose of that is for emergencies. It's not to be used for vacations or things like that. It's for emergencies. But that you before you kind of come up with the assets that you want to allocate into whatever allocation you want, make sure you have appropriate level of emergency cash, and that should be maybe 6 months of living expenses, maybe a year. It's a little bit of personal choice. Some people want to have more. It depends upon the safety of your income. Those that have less regular or safe income might want to have a higher emergency fund. So you do that first. And that's your cash outside of retirement. And then everything else you invest like we're talking about, so that you want to have a certain amount of stocks and bonds. And then you got to look at whether you got the Roth, the non-retirement, the retirement, which asset classes go into which pool to make the best tax efficient investing.
Yeah, there's a lot to it, huh?
There is, it turns out. We probably could do another segment. We really haven't got to the question. The question well, I guess we sort of did. At least my opinion is if you have the ability to sell out of an asset class that's higher and it's in the right tax pool, I'll sort of qualify it with that. Then go ahead and sell that asset class because you're getting a distribution.
No, but if he needs more, then where does he go?
Well, then it's a little more complicated, right? Because if you sell one asset class, nothing is going to be perfectly in balance at any time. So there'd be certain asset classes that are more likely to rebalance than others. And if there just isn't, like let's say everything's in balance, like perfect storm, right? Where do you get the money from? And so in that case, to me, it doesn't matter as much. But then you're going to have to rebalance if you want to stay in perfect harmony. Whatever you sell out of, you're going to need to buy back. Right?
So would you take it equally out of each asset class that you own?
No, because
the trading costs would probably kill you.
Too expensive. So when we talk about keeping things in balance, perfect balance is not realistic. You want to get as close to perfect as possible without creating too many trades.